Got a couple more coming in. Oakville, Ontario represented. Okay, so we're going to dive right in. I'm sure that there will be some more folks joining over the course of the next few minutes here. It's natural for lunchtime. You got to get your sandwich and you got to get, tucked in, no problem. So I'm going to dive in and welcome everyone to this special edition of Insider HustleStruggz, where we're focusing on that dang market. Oh, sorry, Alex. It's we'll deal with that later. We'll get you a sandwich later. Don't worry. But we have these HustleStruggz events every month for the insiders community. But this month, it only made sense to open up because of the changes that are happening. And so we wanted to make it more of an AMA, adapting your growth strategy to changing funding environments. Since, typically with HustleStruggz, we talk about, the struggles of hustling. So to kind of give a bit of a background on that, this is what we do every month. We have a series called Insider HustleStruggz, where we have a fireside chat that's all about sharing perspectives about navigating the challenges of early entrepreneurship. So topics that we've done before have included, how to hire for your core team as opposed to hiring for, a scaling team. Last month, we talked about evaluating different types of seed sources. And this month, we're talking about, how to adapt your growth strategy when it comes to the market changing. So I'm going to just kind of do a bit of a spiel here. My name is Laura Backman, if you didn't hear me introduce myself before, and I'm the Insiders Manager for TechTO. If you haven't heard about the TechTO Insider membership, stay tuned, and I'll be putting a link in to apply for a free membership later on in the event. As I mentioned, we wanted to open up today's HustleStruggz event to the general public and our general audience because the topic is relevant to a much wider audience these days. And so we recognize that there are a lot of people who are experiencing changes to their businesses or their employment status as a result of market conditions, and we're excited to hear questions and help navigate them strategically. So in a moment, I'm going to invite Alex Norman up to the stage to start the discussion. And once he's up here, you're going to see a little button become available in the upper right corner of the screen. So if you have a question that you want to join us on stage to ask, please click on that button and our producers will go through the tech checks with you so that you're ready to join the stage when we're ready to take your question. Also remember that there's a wonderful and active chat in the right of your screen where you can also enter questions. So if you prefer not to have us watch you eat a sandwich, or if you're otherwise occupied but you still want us to answer your question, feel free to enter your question into the chat and we'll make sure that we chat about it while we're on stage. So to introduce my co-host today, I'm sure that plenty of people are very familiar with him, but Alex Norman is the co-founder of TechTO and a partner at N49P Ventures. He's got tons of experience as an angel investor in Canada, and he also hosts a lot of TechTO's events as well as our tech news podcast called Quick Takes every Thursday morning. So please give a warm welcome to Alex Norman and help me welcome him up to the stage.
Thanks, Laura.
How are you doing?
Good. More important than any of the other things in the introduction, I'm old. So I've seen 01, I've seen 08. I was at a startup in San Francisco in 01. I was a consulting firm at 08, but I've lived through a few downturns and seen variations of this economy before.
Right. So I'm going to stop my screen share. We're going to go actual fireside here now. If our producer can add a little GIF up to the screen. So there, it's a real fireside chat now. And I just wanted to open up and ask you, considering you have the experience that you bring, watching the market go through so many different, tips and turns and roller coasters over the years, what inspired you to have this chat today and what made you want to answer these kinds of questions?
I think it's the narrative that's being put out there right now. I think if you go back over the last 2 years, COVID hit, everyone thought the world was going to end, but we quickly recovered, and it's been 2 years of euphoria in tech, especially in Canada. Now, every day, you're hearing of layoffs and how tough the market's come. You're getting articles in Global Mail how the sky's falling. There's layoffs.fyi is a site everyone's bookmarking. And I think, the economy has changed and the environment's changed, but it's not as bad as people think it is. But a lot of people have questions. A lot of people are like, I'm getting asked every day by my founders in my portfolio for advice. So when the team was talking, we said, okay, how can we answer people's questions?
Right. And that's just it. There's so many things being reported, I also want to just mention the Y Combinator letter that came out a few weeks ago, and that kind of sparked a lot of this. And so considering that that's kind of how the information is being delivered, there's a lot that's going on LinkedIn, there's lots being kind of chatted about in the media, thinking about it from the business perspective and the strategic perspective, how how do investor and board level expectations change, or when these kinds of public changes occur, or we're in
Yeah.
these kinds of freezing moments.
So a couple caveats. First of all, that's an interesting question to start with, but like every company, what's important is the team and how to react to it. And all generic advice is generic, and your mileage may vary with any advice. So I would say let's start with current investors or board members, and then talk about new potential investors. Um, Board members have a fiduciary responsibility to investors to make sure the company does the right thing. So the key stakeholder they're worried about is, people have put money at risk in the companies. And I think the reaction is couplefold. One is how companies are getting valued, and incentives to get that value have changed. So let's realign around the new incentives. And second of all, there's a feeling that at best there's uncertainty in the economy, at worst there's a recession coming. So let's prepare for that. And I think the third complicated factor is if a company's raised in the last 12 months, they raise at a much different valuation scheme. So it's probably ahead of where it should be from a valuation of current market. So what these investors and board members are doing reviews of the companies, understand where they're at, and then saying, okay, how much money or how much runway do we need to give our chances of succeeding? And that usually means let's lower the growth rate, let's get more ability to burn or get closer to break even, and give ourselves 24 to 36 months so we can grow into that valuation and or find product market fit. So it's gone from growth at all costs to let's take a measured approach to building this business. And I think there's many different permutations of how this looks. I think for new investors is they're applying that there's no FOMO. They're not rushing to make deals, and they're focusing a lot more on due diligence to understand, can this company become massive? Can this company spin off cash when it's massive? And what's a fair price to pay for today? Not with what it will be doing in a year or two, which is what was happening 6 months ago or 9 months ago. So those investors haven't deployed cash yet, so they're going to take their time. They're not going to feel FOMO. They're going to take, they're going to be much more measured in how they invest in companies. But I that's all that though is from a fiduciary responsibility and investor perspective, not necessarily a team or management perspective.
Right. And fair to say it's a very case by case basis, and you just kind of have to increase the magnification on the lens through which you're looking at every company, and how they funded a year ago
Yeah.
versus what they're doing now. So when it comes to evaluating, okay, do I need to update my growth strategy? Am I optimizing for growth or for runway? Can you provide some context, or perhaps some insight as to what are the trigger points where it's like, okay, we should be optimizing for growth, or we should be optimizing for runway?
So I would say let's break the world into two simple type of companies: pre-product market fit or post-product market fit. I'll start with pre-product market fit because generally our community is earlier stage companies. And again, so I'll assume they're pre-product market fit, or if they've exhibited product market fit, it's not consistently exhibited. So if you're pre-product market fit, you should be focused on giving yourself as much time to get the product market fit, exhibit that it's real and what that means. And so usually that means is extending your runway by having a relatively lean team where everyone is either helping you build the product or sell the product. And probably more, in the beginning, before product market fit, that could be customer development, that be figuring out, non-skippable go to market. So, if again, I just look at analogy, my portfolio, we've had lots of few conversations where we reviewed hiring plans or reviewed a current team and said, what's the real size team we need to get to product market fit? Let's give us as much time, because just because you've got product market fit, you're not going to get a big boost in valuation. So I think that's pre-product market fit. And then I think post product market fit and you've raised money, the equation there is a bit more nuanced. It's what was the last valuation? With your current growth rate in a new market, can you grow into a valuation that's as equal or higher? If not, can you trade off growth? Can you trade off slower growth for more burn rate and get a more chance that the environment improves, or you get the growth rate you need to? So those conversations are more nuanced, and it depends how much cash you have, what the valuation was, how fast you're growing. So example, I have a company that I know has 24 months runway. They're growing 15% month over month. They don't think a recession will impact them. They're probably not going to change anything, because by the time they go raise, they'll have 4x revenue. So even if the market falls by 60%, they should be in good position. Other companies, have 6 months runway, valuations down significantly. They might want to cut significantly and give themselves 12 months to grow instead of 10% a month, 8% a month, but end up in a much stronger, healthier position with better unit economics when they go raise.
Gotcha. And we have a great question in the chat right now from Sam Anderson. Thanks so much for asking this, Sam. He's asking, does the long runway consideration change the philosophy of quote unquote, each raise should give you 18 months runway?
So in this market, you're seeing US VCs talk about 24 to 36 months runway. I'm skeptical of that. I think there's a bit of, hey, we don't know how long this will last, and it's gonna get worse before it gets better. So you don't want to be raising in 9 months when it's the worst possible. I also think there's a reflection there that what used to take a month to raise now takes 4 to 6 months to raise. So if you have 18 months to raise, you have to believe in 12 months your company's ready to raise. I also think there's lots of VCs have a lot of capital deployed, so they want to go back to companies that have 20 months runway that they believe are winners, and sell them 12 more months of capital or 16 more months of capital. So I think in Canada, historically, I would see 12 to 18 months being raised, in the States to be 18 to 24 months. My perspective is it's probably more around the 24 months, give or take 6 months right now. But the key thing being how confident you are, you can get to a key inflection point which unlocks value. And again, it depends on your stage. So can you get to product market fit and prove it, that you're growing quickly? Can you get to X number of revenue and unit economics look good? So I think you should be buying enough time to prove you have a great business. There's still a lot of money on the side. That money has to be invested, but the bars are higher. And if you can prove you need to prove what you need to do in 12 months, raise for 18 months. But if you think it's going to take longer, or you think there's uncertainty, if a recession hits and your customers are going to stop spending, you need more time. So again, it's individualized. I'm personally targeting 24 months with most of my portfolio companies. If you talk to someone in the Valley, they're targeting 36 months. And so again, raise for 18 months. The problem is if you raise for 36 months, either you're going to take more dilution to reflect the current valuations, or you have to convince someone that you get an old valuation, which is hard, right? So it's also optimizing for how much money you can raise.
Awesome. So and obviously if anyone has a magic crystal 8 ball that tells you exactly what, the world's going to be like in 12 months, please let us know so that we can talk about it with the community. But Leah has a good follow-up question. Does this change the way that companies should approach their pitches and pitching strategy? If they're in that process right now, what should the caveats be, or are there any other opportunities that they should be highlighting in the way that they go for funding?
I don't think the way you pitch or what you pitch changes. I think what's changed is how long it will take you to raise a round. Like the round raise over a weekend, which was always extreme, doesn't happen right now. It's like fast rounds are 2 to 3 months. I think the valuations are down significantly. I think I'm starting to see it even in earlier stages. And I think with the valuations down, how does that impact you? Is it's being more clear what you want to achieve with the money and what the team you need to do. Like I've spoken to founders to say, hey, we want to raise 3 million on 15 posts. I'm like, there's 3 employees. How many are you going to hire? Oh, 0. So why do you need $3 million? Right. So I don't know what let's say there's 3 founders and they want to pay themselves for 3 years. I don't know what they figure right salaries, but let's say it's 100,000. I'm not going to say that's right. That's wrong. So that's 300,000 salary. Let's put overhead. So that's 450. Even if you want to last 3 years, that's like 1.5, not 3. So like, there's more questions about how money is being used. So and it's also what's a realistic expectation. I was speaking to a founder the other day, and they're like, okay, we're gonna get to like 20,000 monthly revenue after this round, and we're gonna raise. I'm like, well, you're looking at raising it X dollars right now. If you get to that 20,000, which is your target, you still won't be worth it as much as you're trying to raise right now. So you're ahead of where you should be given the current market. Like, because the key thing is, I think the key hardest thing for founders is lots of announcements and rounds being now announced are 6 to 12 months old, and they don't understand where valuations are, or they think they're they're unique. And again, early stage is not as impacted as much as like A rounds are down 60%. Um, I saw a company that was advised by its last round of investors to raise at, let's call it 9 figures, and they're going to be closing around now today at a third of that. And the only thing
Right.
that changed is not that they're bad companies, just valuations have changed. And I'm starting to see that a lot of places. And that's at A rounds. The earlier rounds it hasn't hit yet, but it has because deals are just not happening.
Gotcha. So the next question that we have in the chat is, given the market, should an entrepreneur focus on nurturing current customers or users, or trying to acquire? Let's talk about customer acquisition and opportunity in that
Well,
respect.
I don't think that question is different than any other question. It's like,
Hmm.
like, look, you're going to get rewarded for growth and you get rewarded for retention. And maybe you can get growth and retention by cross selling more to that current customer. I think it comes down to unit economics. If you're attracting customers that are churning after 3 months, or you're attracting customers that cost you $1,000 to get that customer and they only generate $500 in revenue, you probably want to focus on better retaining and serving your current customers till it makes sense to go acquire new customers. Because you don't need to be spending $2 to make a dollar. But if
Hmm.
you can show me you can scale up and spend a dollar to make $5 and consistently, you should be probably going and growing your business. So I think it depends on the economics. And again, if you're early on and you don't know these numbers, I'd focus on small numbers, understanding, and continue iterating and iterating based on what you learn.
Gotcha. So thinking from like the customer success, existing customer success perspective, and trying to balance that with whether or not we're going to, pound the pavement and sell as much as we can to new customers. Are there any other, I guess, opportunities that you would highlight, that might be worth someone adding to a pitch deck, or even just, taking advantage of, or even any
Oh,
other maybe strategic advice that founders and entrepreneurs should be looking for in terms of
look,
opening up new opportunities?
I think there's you know, you'll hear a lot of, hey, it's a great time to start a company. And I think historically, a lot of times it's been great because there's been a technology change. Like in '08, you were the iPhone was basically introducing that, Apple's App Store. In '01, it was the laying of cables, and which enabled, you went from dial up to high broadband. So there's a bit of technological change. You could say maybe there's crypto changes here, but I think the one thing I'm confident about, um, is your cost of doing business has decreased. If you were trying to recruit someone out of, let's say, Shopify or Amazon or any public company or late stage company, it was near damn impossible without giving a huge equity stake in salary. Now the risk of joining an early stage company is a lot less, and you could be able to even have that conversation and probably recruit people cheaper. Second of all, um, people are distributed teams and we're thinking about going to office. If you want to have an office, it's probably much cheaper to sublet an office. And if we do hit a recession, cost of paid advertising should decrease. People will be more willing to negotiate. So the cost of doing business should decrease. If you can increase someone's revenue, they should be much more eager to talk to you. um, so the flip side of a challenging environment is it's challenging for everyone, and it lowers your cost of being in business.
Right, right. So we've got a question from Karn, who's an insider. He's great. He's new to the insider community, and he's asking, how are companies seeking funding in the seed round being looked at differently? Because you did mention that A is being more impacted. 60% fewer A rounds these days. But what is happening to the seed stage companies?
So there's a lot more questions up front about what do we have to believe that this works out to be a good tech company. So I think a lot of, let's call it tech enabled businesses were treated like tech companies. I think they're having a harder time. So, like, I'll give you an example: a direct to consumer Shopify store. Hey, I'm selling, I don't know, a new clothing line that's eco-friendly. So, oh, it's climate tech, it's e-commerce. Before that would get valued like a tech company. That's now being reevaluated by, hey, this is really an apparel company. The margins will be lower. Can the scales quick? Same with like 15-minute grocery, capital intensive, lots of competition. I think starting something like an adjacent market's much harder than before. Likewise, hey, this is a great software business, but we don't believe it can be. You have to tell me a convincing story why this can be 100 million revenue, because I went to valuing companies at 100x revenue to 10x. So the minimum barrier of scale has increased significantly. I think the other thing is you'll get less credit for what you're selling and more credit for what you've done. So this actually plays the Canadian strength. I think Canadians have always undersold. We always go pitch, here's what we built in the last 6 months, and here's what we're going to do next 6 months. While American would say, hey, here's what we're going to do in the next 24, 36 months, and we're going to be worth $1 billion. I still think you have to have the bravado and sell a big story. But I do think you need to also, having the credibility of actually done stuff is much more valuable now. You're getting paid a lot less for what you're going to deliver than what you've proven.
Got it. Got it. I hope that answers your question, Karn. Let us know if there's any follow-ups, of course. But I'm going to switch over to talking a little bit about, I guess, teams, and obviously maybe a bit more about the company culture side of things these days. So whether we talk about super early stage, we can talk about it in kind of a two-part. What adjustments should be considered when it comes to moving into a market like this one? Who should 100% be on the team? Let's say if you've got a 10-person team versus, what adjustments should people be making, or should be considering making?
So I don't think this is any different than before this current environment, but I think there's less leeway for this. So I think over the last few years, you had people focus on building a company instead of building successful business. And so that would mean, hey, we've raised money. Let's go hire 10, 15 people. Let's go get, I don't know, um, head of marketing, like just filling a bunch of positions when there's no clear ROI. So I think what do you really need? Pre-product market fit, just people that can build and validate the opportunity. I think post-product market fit, you should understand what each person should be able to deliver. Can she go scale the marketing, which generates more leads? So like, and it could be the office manager. Hey, this person's gonna come in and he's gonna give a lot more leverage to everyone else. The salespeople can sell, the founder can have more time. But I think it's by default being a bit leaner than you think you have to be and stretching the team, and then being very careful where you add team members. You know, it's sort of having a good hypothesis on what's the return on investment. So like, if you're again, let's say you're you're a software, you're a delivery. Let's pick on the grocery delivery companies. Hey, you know what? Maybe a good chief logistics officer or head of logistics may come out there. And I think the other thing is there's been a lot of title inflation over the last little while. I'd be a bit more judicious with the titles, because it just leads to all sorts of weird, just be careful. I guess make sure just because someone has a title from the last 2 years that they're qualified for what you need them to do, not just because they're like VP of sales at a 25-person company.
Got it. Yeah, and that makes total sense. And I also think that there's something to be said for the small companies that are, maybe up to 10 people, thinking about, that company culture long term more so than what it is that they're doing. Like, tie the core values of the company and what it is you're trying to accomplish to the product market fit that you're going for, to the kinds of goals that you want to achieve, and then make sure that those align more with the folks who are, on the ground doing things, than just making sure that everyone is happy with their titles. So I guess a follow-up question from me on that would be, it's going to impact morale. An atmosphere like this, watching layoffs happen around you, watching hiring freezes happen, within your company or within the companies around you. If we don't want to overinflate titles, what are some other ways that, a lean team can keep morale solid?
So first, let's talk about the overall environment and psychology here, right? Like everyone loves swinging to extremes, and the large companies are gonna have large numbers of layoffs if they need to, and it's gonna get reported. And then you're gonna only read about the crap in the environment. The gas prices are up. X is laying off. We don't know interest rates are going up. To a certain extent, that's reality. It's never as bad as it seems, and you need to know what's going on in your sector, so you shouldn't be blind. But just sort of ignore it. I think at a company level, I think the best thing a team can do is reiterate the mission, reiterate the objectives, be as transparent as you want to be, but saying, hey, we've made some hard cuts, but this is, it's like being on a diet sucks, right? But if you're way overweight, the best thing you can do, for your health and long term, is take those short term pains. I'm not going to eat the
Mhm.
cookie or ice cream. Trust me, I eat cookies and ice cream every day, and I struggle to not eat it. But if I it's just be clear to the team. Hey, we know we want more people, or we had to let some people go, but it's for overall health of the company in the long run. We're going to take care of people here. Treat your people right, pay them well, give them the incentives, and reiterate the mission, and make sure that the people are there for a ride, and that they get that. You make sure you train them, make sure to make sure if it doesn't work out, they're going to have better opportunities than they had when they joined you. And I think so. It's reiterate mission, be transparent, explain the logic, show the progress, focus on the wins and losses, and take care of your people. You know, it's very easy to say, it's very hard to do. And I think as team leaders, it's a fine line between sharing your emotions and not being, like, you don't want to just come in and, like, like maybe you do, you want to be like super happy and pumped every day when you're getting hit in the face every day, but you also don't want to come down and say, fuck, I don't know how we're going to survive, right? And I think that's
Mhm.
up to each culture and each leader and how they communicate and share those struggles and
So,
enthusiasm.
yeah, to
Like
kind of summarize.
Jason
Oh,
and
sorry.
me,
Go for it.
Jason and me will communicate very differently, right? Like I'm not naturally like the cheerleader, and he's not someone that naturally is, like, I won't say I'm pessimistic, but like, like, so you're gonna, if I had to give advice to him on how to motivate a team versus how I'd motivate a team, it'd be not genuine for him.
He's got pom poms in his backpack. He's definitely more the cheerleader type. But I'd say, like, to kind of summarize that, it does go back to, lead by example, be transparent. You can't really please everyone, but at the same time, being transparent and trusting that folks are going to stick along for the ride will also prove, who does show the core values of that you want to, also trickle down to the team once the team can grow. Who really is here for the long haul and who is passionate about what they're doing, because you want folks to be passionate, especially throughout these times, because it's going to good mood spreads faster than anything, and a bad mood is wildfire. So it's really important to also make sure that the people that you have in place are able to lead by example in that way.
I agree with you 100% there.
Awesome. So really, if if I don't really have any other, I'm at the end of the questions that we chatted about, or that I wanted to cover here. I'd love to know if there's any others, because we have about 5 more minutes to cover questions from the audience. So if anyone does have a question, I think it would be great to hear from them. But I also want to ask you, Alex, are there any other questions that you think founders should be asking right now, in order to kind of move through these times, so to speak?
Well, I think the strongest founders are a bit naive about the world. That's because otherwise you would never start a company. It's you're fighting a lot of inertia. So I think as a founder, it's like, what are my assumptions have to be true to make this business work? Which ones do I think that might be true but may change if the environment changes? So, like, for example, if you're selling to startups and only tech startups, what if funding slows down and significant amount of startups go to sell out of business? Can this business survive? Can we sell to SMBs or non-tech related companies? Or so, like, what or what do I believe if remote's the way to go? Just distributed teams. But what if a recession plus, will allow employers more leverage and force people to come back? How do I see that? How do I change for that ahead of time? So know what assumptions you're building your business on. Know which ones you're pretty confident that may change if the environment changes. Um, and you don't have to maybe do anything, but be aware and start being, so that you can do anything if those assumptions change. What the great thing about being founders is most people think founders and leaders are risk takers. The best ones are opportunity seekers that mitigate risk. So again, this is just another look. Be aware of what risk you may have not been aware of before that may now exist or may come to exist.
So even on that note, talk about, I think it's more important than ever before to have a contingency plan, like also built in
Mm.
space based. What do you think about that?
So the old contingency plan in the last few years has been let's raise a shit ton of money. I
Right.
think that makes a lot of companies easy and lets you make a lot. It makes you a little slower to lose a mistake. I think there's contingency plans that are healthy, and there's contingency plans that like some company, like what's the classic when maybe not a good analogy when the Spaniards invaded Mexico, like they burnt their ships. Cortez burnt the ships, so you couldn't go back. No way back. So to some extent, you know, it might be good to not have a hey, if this doesn't work, we're going to sell. Well, you will end up selling the business, right? Like so,
Hmm.
there's contingency plans. I'd say there's plans to find a better, hey, this road's blocked. Let's take another fork in the road, go back and double back. But like, there's also contingency plans which give you, which may not be good.
Got it. Yeah. I mean, don't burn all your ships,
Well, no,
don't, but
I'm saying you might want to burn all your shifts, but
might want to.
because yeah, it's like yeah, like the contingency plan is I've got an offer here from Facebook for $5 million, and I'm trying to build something that's worth $1 billion. It you might after 2 months just say, okay, fuck it, let's sell. Maybe it's the right choice, but like, yeah.
The other thing I would say is because there's so many questions flying around in the industry right now, I think that there's also something to be said for where you get your advice from, and
Yeah.
kind of seeking second opinions. So can you talk about how you feel about when like seeking second opinions and making sure that you're taking advice from a variety of sources
So
or trying to aggregate it, so to speak?
remember, you're running your business. Everyone else doesn't is getting a point of information. So it's up to you to make informed decisions. And any analogies or advice is contextually based on what that person's experienced. I usually say that it's good to have a community of founders you can talk to. Some can be like the TechTO community, or you can have a group of like I have a group of 5, 6 founders that I get together with every 2 to 3 months to just talk about stuff. And usually it's me saying, here's my, I feel open enough to give them like a 2 hour explanation of what I do. And then they can just question me and push me in the right direction. So, those are a couple things. I think the other thing is looking for people who have done it before and getting advice from them. Like there's not one source. What I would not do is just read stuff on the web and say, okay, that's the only way to do it. Right. Like the key thing is no one's running your business. There's some frameworks that are more true than others, right? Like don't spend $5 to make $1 is a pretty good thing. You can be pretty sure is a good advice. But like, should I go to Instagram or TikTok or whatever channel, acquisition channel? Should I hire a marketing person, a salesperson? Those are personalized, and you might want to like. You need either people very close to you or can tell you contextually right information.
So kind of like build a community that understands what you're
Mhm.
going for, and maybe has been through a similar experience. So we have one more question from the audience. Thanks so much for typing it out, Arun. So he's asking, given customer acquisition is slow at the beginning of a startup, would you suggest new founders to double down on product development or customer growth given the limited resources that we have in these market conditions?
So I'm not exactly sure. I understand. Again, don't understand the full context of this question, but I'd say what you're trying to prove at the early stages is product market fit. You don't necessarily have to have scale. So how do you prove you have to cut? How do you build a product that the customers love and will use and will start pulling from you? So I think it's a mix of building, but building without getting customers may not lead to the right information. Just getting lots of customers to churn through are not right. So it's the right mix and understanding you can do acquire, like I think the key thing there is, use your limited resources to, I want to call it growth hack, but do stuff that don't scale to acquire customers. And then once you see that you got product market fit is you can then worry about growing faster, What you don't want to do is get 100,000 customers, all of them have a shitty experience and they burn out, and then you have to go find another 100,000. So like I was talking to a team right now, they're going to Facebook groups, introducing themselves, and you're getting 10 or 20 customers from like a week-long conversation. That's something that's, 300, over a year, that's, 520 customers. That's great. It doesn't scale, but they're using that to have meaningful engagements and judge product market fit. And if that works, I'm sure it'll go beyond Facebook groups.
So to kind of, considering our last question was about, building a community of co-founders and folks who have been through the similar experiences as a community of people to get advice from. It's almost a similar mentality for, growth at the ground level, which is, almost looking at your customer opportunities as research and, building a community around making sure that that product market fit is really solid, right?
That's correct.
It's a wonderful actual point to kind of end this off on. And I'd say, thank you for everyone who asked questions. But, our insiders membership is something that, it's an environment where you can ask a lot of these kinds of questions and have a lot of these kinds of candid conversations. And so if you or a friend or anyone in the community has been impacted by what's going on, whether it's a layoff, whether it's a hiring freeze, whether it's just needing to get that that community that can provide a second or third opinion, I'd love to welcome them into our TechTO insiders community. We're really, really nurturing, and everyone that I have talked to has been so kind and so lovely. And so if you'd like to apply for me to send you a link to sign up for free for your first year, I'm going to put that in the chat right now, and I hope that you respond with it. Or if you're already an insider, then you can even throw in the chat about what you enjoy about being an insider or what the insiders membership has done for you so far. But these are the kinds of conversations that we want to enable, and we are kind of in the business of helping founders, learn to start up strategically and build a community that can help them start up strategically. So I want to thank everyone for sticking around through the AMA. We're going to flip to networking so that y'all can either talk to me or talk to each other about if you liked this session. But we really appreciate your time, and we are really grateful that everyone is part of the TechTO community, and we hope to speak with you all soon.